Okay, so hi everyone, welcome to our webinar today with NPEA. I'm Sabrina, I'm coordinator at NPEA, and today we have investment director for BO2, Deepak Dai, here with us to have a conversation. So Deepak Dai, why don't I pass the mic on to you, and you can give us a brief introduction about what you do and sort of like what is your role at BO2 Funded Equity.
Okay, sure. Thank you, Sabrina. I'm Deepak Sharma, Investment Director at Business Oxygen Private Limited. So Business Oxygen is a SME fund promoted by IFC, FCDO, and Climate Investment Fund. So we invest in SMEs and we are sector agnostic fund. So our fund size was $14.3 million and we have already exhausted our investments. So we're at the moment looking for second fundraise and doing the monitoring and exits that we have in hand.
Okay.
And the target ticket size was initially $100,000 to $500,000, but later on with the FDI limit being increased to $500,000, we started doing $500,000 ticket size.
Yeah.
So I've been associated with BO2 since last 8 years, and BO2 started investing from 2016.
Okay. And I'm assuming that given your role as investment director, you do a lot of relationship management and conversations with investors who invest in funds. Yeah. So as a good conversation, so we're going to focus on how sort of PVC firms maintain relationships with their investors.
Okay, sure.
What would you say are some key challenges that arise when you're building partnerships for private equities with investors?
So Sabrina, before going to this, I think we can start with a little bit on what is private equity and what is the relationship between LPs and GPs, how it works. So in our case, when I give the introduction about BO2, so when I said our fund is backed by IFC, FCDO, and CIF. Right. So basically these three are our limited partner, general partners, who limited partners who are the investors into the fund. Right. So their role is limited and they are here as an investor alone. And they trust the fund. The SPV is created, which is a private equity fund. And this fund is managed by general partner. General partner are the fund managers. So they also have the skin in the game. And depending upon the structure, there is the mix of certain component from the general partner as well. So when the pool is created and private equity fund is created, the role of managing that fund is given to the general partners, right?
Right.
So the discussion we are having today is how to have how the relationship between LPs and GPs work.
Right.
So in this structure, LPs, they provide the money and they have a certain mandate, and GPs, they are into the execution of the fund. Right. So the objective here is to generate a return from the fund we create. We make investments and we make the return for both LPs and GPs, right? But even when there are common objectives, there can be differences in the understanding and there can be certain challenges, right? So when we're talking about the markets like Nepal, the market itself is very fragile, and there can be differences in the understanding of the market itself.
Right.
And other thing is, the understanding of the market can differ also because a lot of time Nepal being the neighbor of India and China, there can be a comparison between this country, but which is completely irrelevant from my perspective, because we are completely different economy and doing business is very different in India and Nepal. And even when we add the listed companies and the investment sector opportunities, it is completely different. Also, when we're looking at the LP-GP partnership in creating a private equity fund, there are a very limited track record we have. And legal structure was not clear, which is getting clear over time. And we're still to get there. And also on the enforceability of the legal documents, we try to clear out a lot of things in black and white in the paper, right? But the enforceability of legal document, how enforceable they are, is still not clear. And also the legal environment here keeps changing. And so it's not very definite. We had a very fluid kind of structure initially. We didn't know how the private equity to be structured here. So there can be a lot of challenges when we try to create this relationship. And the relationship, when negotiated, starts with the documentation. And in the documentation side, enforceability and the changing legal environment comes as a huge challenge.
Right.
On the return requirement and the commercial viability, and also like if they want to have the fund in onshore structure or offshore structure, there are a lot of challenges that we face during the partnership for private equities in Nepal.
Right, right. And of course, like there's always like, NPA hosting these like legal, like Hammer internal validation workshops and stuff like that. So do you see like a foreseeable, like a positive future when it comes to your legal groundwork sort of changing in the favor of private equities?
Definitely. Like even yesterday we had a session, right? So I think not yesterday, day before yesterday. So there are certain problems that we all have. We different private equity players here. We have different kind of problems and our own set of problems. Like I work for a fund which is backed by FDI. So the problem or challenges we face can be completely different from the challenges that are being faced by the local funds.
Right.
And we are structured as an investment company, and the funds which are structured in SIF model or which are being registered in SIF. Back then when we started, there was no SIF. So the problem for SIF can be completely different. And even now, merchant banks have come into this space. So their set of challenges can be completely different.
Right.
But there can be common sets of problem as well. And we have been lobbying, and SIF itself is one of the result of our consistent lobbying that this sector should be recognized by the government, and this has to be recognized as an asset class. So we can pitch to the international community that Nepal is ready for this kind of collaboration. So eventually this happens, and we have been consistently lobbying on individual capacity as well, or from the side of association, and this kind of interaction programs where we come together and see what could be the beneficial alternative or beneficial way out for all of us is definitely a very helpful step.
Right. Okay. So moving from challenges to more so of a communication sort of thing, how do you think like is the best and the most effective way to create a very like cohesive collaboration with like say your yeah.
So when we're talking about the communication and collaboration part, so before the negotiation or when we are trying to raise fund or we are trying to onboard them, it seems like we're on the two sides of the table. But the exercise at the end is to be on the same side, right? And when someone is investing into an economy, they will definitely have a due diligence of that particular area, and definitely they will also do the diligence of the private equity venture capital sector and also the sectors they will be investing into, and also there will be a due diligence for the fund managers as well. So when the fund managers are trying to create this kind of collaboration, I think it should be the transparency that comes first. So we need to be very transparent with what we want to do with. For example, if an investor say, like we want to create $100 million fund, and you need to be very thorough with if you have that kind of appetite or that kind of pipeline or not. So this kind of communication and this kind of things should be very transparent upfront. And there should be clarity of like where you want to make the do the investments or what kind of impact the LPs are looking for, and if they can be catered into or not. And even we go into execution after we have gone into an agreement, then you have to inform them on all the problems, legal hassles, or the headwinds you face in time. And there should be alignment of the objectives, right? So when LPs are here, they can have multiple objectives. For example, from our perspective, when IFC is a profit-oriented investment making arm of World Bank, and when we're working with FCDO, and they were more into social impact. And when we're working with Climate Investment Fund, the angle comes from climate smart approaches. So with climate smart approaches, it doesn't mean that all the investment has to be in use, renewable, or something like that. But that could be small climate smart approaches that we can incorporate in the investments we make, right? So there can be different objectives of the different investors. And when we create a fund as a melting pot of all these different angles, there should be alignment of what fund as a whole is trying to do. And according to that, there should be the timely reporting on all the aspects. There could be reporting on the ESG measures, there could be impact reporting, there could be financial reporting, or there could be reporting on the development that fund has been doing and fund's performance itself or the portfolio's performance. So there are certain communication tools in form of reporting. It has been placed there, right? And the reporting format, I think, is it should be very specific to the fund, and it can be agile to accommodate the requirements of the limited partners so that they know exactly what they are looking for and they get that information from there. And you can have regular engagement through advisory committee meetings. So advisory committee is a board committee where there would be a representation from the investors and as well as the fund managers. So when you come together and engage and discuss the problem, the frequency of the reporting, frequency of the meetings, so you come discuss the problem, and you also identify the solution, and you determine the timeline for this, and you also determine the alternative strategy that you want to deploy. So in this way, you are involved in the process together, rather than there is a gap between the implementing agent, that is fund manager, and the one who is looking forward for the return from the investments. So there can be this kind of mechanism which can be installed initially at the time of investment itself.
Right. Okay. I guess that sort of answers what the next question I was going to go to. But I guess, like, let's talk a little bit about negotiations and how you navigate, like, you know, a relationship or a partnership that's sort of mutually beneficial for both. Like when you're going into this partnership, you're thinking, okay, this is beneficial not just for you, but also for me. And how do you sort of negotiate that, that investment?
So when we are talking about the negotiations, then we should understand few terms, like alignment of objectives. We already talked about, right? So you need to align what are the objectives are. If you want to have a social impact, or you want to have economic return from the investments, or there can be like geographical fencing, like you want to have this kind of access to finance major in this particular geography. This would be alignment on of the objective at the first. And then comes like, what is the structure you want to work on? Right. So it can be onshore fund, it can be offshore fund, and it can be debt or equity components that you have to structure in the fund. So what would be the equity component coming into, what would be the debt component coming into, and what is the ticket size or the fund size you're looking at? So a week back, we were also discussing about a fund that was to be structured in Africa. And because of the volatile environment, and there was no such huge fund demand from the economy itself, they were looking for the regional fund rather than the specific fund domicile in that country. So there can be a structure where there is a regional fund investing into different jurisdiction, or there can be a specific jurisdiction fund domicile in that particular jurisdiction, or that's offshore. Right. And also when we're negotiating the terms, another form is hurdle rate. Hurdle rate is the minimum return expectation that comes from the LPs. And that hurdle rate is one of the major terms that we have to negotiate. And if there is like investors who want to contribute to the impact of the particular sector, and there is a other angle for them, the hurdle rate might be less. But what we should also not forget is what we're trying to do is create an impact on the access to finance side where the risk capital is being provided, right? So there should be a situation where investors' requirement is also met, so that we do not have to rely on DFIs for long, but commercial investors can also come here. Eventually, we can reach there. But hurdle rate is the minimum return expectation. So what is their expectation? You need to understand, so that a fund manager can have an idea like if this is doable or not. And this has to be, this is already incorporated in the initial investment document. And this is one of the point of negotiation. Now there comes the carry. So if the minimum hurdle rate is achieved, above that, if there is any return, so that has to be shared to certain component of that is also shared to the fund managers, GP. So what component will this be? So carry should be in there. And another is distribution model. If you make the investments and the investments start to realize money, then what would be the methods of distribution? Which will be the priority? Who will get the money first? So this distribution model is also important to be negotiated, right? So another important aspect is method of equalization. So equalization is, for example, you create a fund of 50 million and initially you raise 10, right? So 6 months down the line, again, you raise another. So there are different clauses, right? So when you are having a subsequent clause, how do you equalize or compensate for the partners who were already into the fund and who have already made the investments or borne the expenses? So these equalization models has to be cleared initially so that you can negotiate appropriately with the subsequent investors.
Right.
Also, what will be the investing period? What will be the harvesting period? This has to be also very clear from the upfront. So generally, fund is a close-ended fund. So it can have a period of 10 years with 1+1 extension or +2 years of extension. In this period, what do you want to do? If you want to invest for the initial 5 years and then have the harvesting period of 5 years, and for certain issues, like if you want to extend the investment period, then what will be the clauses for that extension? So this has to be negotiated. Another part is the sector. So in what sector you are going to invest? So this sectors has to be defined. So for BO2, the sector was sector agnostic. Until the time we're not investing in the negative list for FDI, and we are within the ticket size, and we're investing in SMEs as per the definition of IFC, then we're sector agnostic. But if there is a sector focus, for example, if you are into renewable energy sector alone, and fund manager has to decide, has to convince the investor if that size of fund is doable for a particular sector or not. If not, maybe sector agnostic would be an option.
Right.
And also, what will be your management fees? Is it feasible for the fund manager to work on that fees or not? In Nepal, so the fund size compared to other countries is smaller. So for that fund size, if that percentage of your management fee is doable for the fund manager or not. And one of the most significant component and the differentiator for a private equity fund from the debt, traditional collateral-based debt financing is TA component and the handholding we provide, right? So if there will be a TA component for your portfolio companies or not, that should also be discussed. And at times, TA may not be technical assistance fund, may not be just for your portfolio companies. It may be for the fund managers as well, or the capacity enhancement of the fund managers to manage the fund. So these are the few things. So maybe I didn't comment much here.
No, definitely. That's all very, very educational, I think. Also, like, I think my last question, and I think we can sort of draw from everything you have said so far, is that, and I think all of these aspects would sort of contribute to a good relation, a long-term relation between an LP and a GP. So in just a few words, like, what do you think are some good practices for PE firms to have a long-lasting relationships with their, with their investors?
So maybe this question will be like summary of what we have discussed so far, right? So market is still in the making, right? So we're still to get there where we can say like now PVC is in the robust stage. Be very honest, even now, like many people don't even know like PVC exists, and we're still in the process of educating them, be it regulators, be it the SMEs that we're investing or the portfolio companies we're investing in. A lot of the even professionals, they are not very aware of how PVC works. So in this situation, we're trying to convince the limited partners who are domiciled abroad to come and invest in this economy. So as I said earlier, transparency and trust is very important. And to build a long-term partnership, it can be just the negotiation between the fund manager and the investors, but it has to be also recognized by the policy regulators, right? So policy lobbying for enabling environment is one of the very key factor here. So recently we had NRB blacklisting provision for local FDI-backed fund. And we negotiated, we lobbied, and eventually at least we could come up with the local funds with more than 50% of the FDI is waived from the NRB blacklisting provision with certain caveats. Similarly, SEBUN has waived lock-in periods. So these are the process. These are things where even the investors will be motivated to come and invest in this economy. It's not just about the relationship that we try to build between the fund managers and the investors, but it has to be backed by the policy as well. So they feel comfortable here that even the country is welcoming them, right? So we need to create an environment where we attract more UNSO funds here. And when we have the headwinds, we can also take the help of the local offices of the investors. For example, IFC has its local office here, but maybe our investment is not from the local office, but from the international office. But if there is a problem here, maybe the local office understands it more appropriately, more precisely. So when we're having those kinds of communication with the our investors, the division which look to us, then we can also keep the local offices in the loop. And at times they have been very instrumental in getting the problems solved. So the feedback that goes from their local office is more reliable for them. To create this kind of relationship, even local offices help a lot. And FDI in PVC sector is also the game changer from the perspective of the government as well as the investors. I want to explain how. Because every small investment, it's very difficult for the government to monitor and manage, right? So that was one of the logic that was given when the FDI threshold was increased. So in that case, if the bulk of the fund investment comes into a fund and fund splits it into a smaller investment, then government can have just the monitoring upon the fund, and fund will have the monitoring on their portfolio companies. So it can be a different layer of investing where the job of the government is very easier. And also for the investors, when they're looking at the impact, so 90% of registered businesses are SMEs, right? So when they're talking about investing in SMEs, they can't go into every small investing companies, and the ticket size, the required ticket size of the SMEs is too small for them to even engage with the SMEs directly. So even for the investors' point of view, PVC kind of vehicle can be very significant in getting those impacts. So from the government side, when they are trying to attract more FDI, or even from the investor side, when they are trying to get return as well as impact, so PVC could be a good alternative. So long-term partnership is bound to happen, but we need to definitely work on the policy lobbying side.
Right, definitely. Okay, thank you so much, Deepak Dai. All of that was so helpful, and I hope our viewers enjoy all that you had to say. Thank you so much for taking a
Sure. Thank you so much for giving the platform. And
of course, and we would love to have you back on our webinar soon, one of these days, so we can shed light more light on some of these topics. Thank you so much.